Good afternoon, everyone. Morning for some, evening for others all over the world. Welcome to today's TPO live trade session. I almost said hyper options. That's what I just got done with about a couple of hours ago. Nonetheless, TPO session. Um, as we get started today, I'm going to change things up just a little bit, and I'm going to just blame one of you guys on it. So we'll just leave it at that. Somebody asked me a question the other day, and I started looking into that a little more because it hasn't been something that I've looked at extensively as of late. Actually, probably in the last 6 months, haven't looked at it. And lo and behold, it might be something that this group is very interested in. Slight change in how we do one of the strategies. So I'll get to that here in a second. Before we get started, this is supposed to launch today. Man, it's going to be close. We'll see if everything gets finalized before the end of the day. But the day has come. The laws have changed today. As of today, we are able legally to sell trade partner stock, and we're able to do that. Allow anyone to buy it. You buy any amount, $100, $1,000, $100,000, doesn't matter. So this one has been coming for a while. I know you're like, okay, it's the 15th. It's not quite up, but we're hoping that it's going to be up before the end of the day, and we'll be sending out an email if that's the case. If not, it'll be tomorrow. So a lot of last minute changes there. Nonetheless, it's going to be really cool if you can be part owner in the trading platform that you use. I think it's a huge benefit for you guys. All right, so today is the 15th, of course, and on the schedule was profit stacking, and we might still get into profit stacking a little bit, but I may switch this up. So Thursday, we're going to do crazy calendars. And so what I'm going to do is I'm actually going to talk about crazy calendars Monday, Wednesday combination as opposed to Friday, Monday combination. I know a lot of you have been wanting me to go here, and I just haven't. Part of it is time restraint. Part of it is previously, it's hard to get credits in some of the strategies that we were using with TPO. Crazy calendars might be able to get a credit on these things, but we're going to be going over this, and I'm going to be going over this extensively because it may not be quite as good as what it seems. And if we get to the profit stacking portion today, great. If not, then we'll cover. We'll just kind of swap the two and cover the profit stacking a little more on Thursday. All right. So for those that are new on the call, I do want to welcome you to the call. I also want to warn you that I do not explain everything about these trades on the call, nor can I. It's absolutely impossible. The amount of the library of information that I give out on these calls is just it's quite voluminous, and it can be overwhelming if you come into this call the first time thinking that you're going to walk away understanding everything. Listen, they don't teach this stuff anywhere. You're not going to read this stuff in books. You're not going to find it out. No one else touches this stuff the way that I touch it. Of course, there's nothing new under the sun, right? But there's always different ways of looking at things, and some of them are more popular than others, and some of them are less. So it's not that I've created anything new. It's just that I look at certain things that are there a little bit different than most everybody else. So you're not going to walk away from this call completely understanding everything that I've discussed, because we're going to be discussing quite a few different combinations of trades. Okay, I also want to warn you that while these trades are fantastic, they do not guarantee your success. They are not guaranteed. They are not the holy grail. There are risks. You can make mistakes. There are variables that can change mid-trade on you. There are variables that if you don't understand how they work, they can lead you to make some trades that you wouldn't have otherwise made. So you do need to be very, very careful about how you put these together. You need to make sure you're not reckless. You need to make sure you follow instructions, and you need to make sure that you start small. Starting small, I know some of you have bigger accounts. You need to start small anyway. And why? Because you don't have to have the holy grail to do really well if you can compound a little bit of profit every week. If you can average just $10 a week, you can actually grow a $5,000 account to about $35,000 in 5 years. If you can average $20 a week, you're talking about growing that into 135,000 in 5 years. And that's the power of compounding. And you get up to where you're being able to average $100 a week, and you're talking about potentially 3.4 million in 5 years. Now that's a little bit harder to do, and you're not gonna. I don't think anybody should come in here and just think that immediately they're going to start averaging $100 a week. It's not going to happen. But if and when you get to that point, you're talking about pretty fast growth. You can grow a small account 5,000 into about 30,000 in 6 months. And this is the exact compounding table that you can use for most of these strategies, not all of them, but most of the strategies. Some of the strategies you'll need to be more conservative, use a little bit slower compounding table. But for the trades that we're talking about today, you can absolutely use this compounding table. And I'll explain why. I know this max risk says $150 on a one lot. That would be the max risk. But there is context to that. So we'll talk about that. Nonetheless, your goal should not be in trying to catch Netflix or at $10, or find the next Netflix at $10 and hope you ride it up for the next 7 years and turn $10,000 into $120,000. First of all, you're not going to do it. Second of all, there's a lot of risk there because stocks can crash. And when you're talking about a compounding table like this, and you're slowly going up and then slowly coming down, if you aren't making money, you're not talking about giving your $135,000, for example. If you're in this doing it for 5 years, you average $20 a week. You're not talking about seeing your $135,000 go to back down to 10 if a stock crashes. It's virtually impossible using my money management approach for that to happen. All right, so that absolutely has to be your focus. That absolutely has to be the key. And compounding is where it's at, and generating a small weekly profit is what's going to get you there. All right, so I always start with option insanity. Option insanity is it's the higher margin one. It's the strategy that you can't use that compounding table for, but you can use the profits from option insanity to cross compound and actually increase your trade size in other strategies that you're trading that don't have as much risk or don't require as much margin. And so option insanity is one that I use for excess cash, if you will, excess money that's not being used in the account, because it does require quite a bit of margin, but it is what it is. It's an insane opportunity most of the time if you implement it properly. So it starts off with, so this one is a 5-to-1 option insanity, and we're not going to talk about option insanity until next week in more detail. But this is a 5-to-1. It's where I sell a further out 5 lot and buy a closer 1 lot. And you can see this price difference there is $8 strike difference between those strikes. So I'm buying the lower strikes, selling further out of the money strikes, but I'm selling the further expiration as well. And it created a huge credit, $450. It's $450. You see this nice profit bubble here, break even all the way up to 401. This ends, actually will have ended today. Before the end of the day, I will have completely exited this. There's so many things I've done with this. The first thing I did is, and what you have to understand is if the market tanks, I'm going to make $450 on this trade. that can go a long way to helping increase my trade size for, let's say, crazy calendars, right? So $450 on this trade if the market tanked. Obviously, potential for it to make more. Market would have absolutely had to skyrocket in a very short period of time for me to actually risk something on this trade. This is why I put these on out of the money and usually when the market is up. So I don't do these the same way if the market is trading down. So you got to understand that there's a certain context where I'll trade these. But the first thing that I did is when the market moved down, I actually bought an extra long. So I added a second long, and I added that second long, which took away a little bit of my credit, but then it created this huge profit bubble and shot my break even on this trade up to 407, 407.50, maybe even 408. And so this particular scenario allowed me to hedge this to where I had very little risk because you buy an out of the money 408 for really cheap. Hedge this and then add to it, right? So I added to it, but I didn't only add to it, I also got rid of my 5 shorts. And I got rid of my 5 shorts. I want to say it was 35 cents. I have to go back and look now. I've done a lot of trades since then. But I got rid of my 5 shorts. Maybe it was 25. No, I think it was actually lower than that. Hang on. I think it was, yep, 16 cents. I got rid of my shorts for 16 cents. And then I resold them. The market moved back up, and I actually resold them on Thursday, I believe, of last week for $1 a piece, bringing in basically another $400 that you can add to all of this whole thing. And then I got rid of the extra long at $100. Excuse me, at 335. So that would have been, yep, $100 profit. So I've added, this is kind of what profit stacking is. It's when you're able to exit part of the trade and then put it back on, or and exit and put it back on, or put one on and then exit and then put it back on, et cetera, right? So that's really what profit stacking is, and that's what I've been able to do with this trade. And after today, I'll tally up the exact P&L on this thing, but I want to say it's gonna end up being somewhere around $1,000. And so that's why I do these. They offer all sorts of opportunities, and so again, I can't compound this trade the way it is exactly, but it does go a long way to help cross compound. Okay, now I also trade this in a way, not in a very big way, but I traded in a small hedge fund, and in that hedge fund, I do more option premium selling because that's you can scale that. It's tougher to scale complex option spreads in SPY that expire on a weekly basis. That one, it's a little harder to scale those to a fund type level. So I don't do a lot of that in there, but I do a lot of option premium, like hyper option C4 type trades, if you're familiar with those. And then with the excess cash, I also do some of these option insanity trades. Of course, limit the risk with the margin hedges most of the time, and of course the risk is limited anyway because there is a limitation in how far a stock index market can move up. It's not gonna go up 10% in a week, right? It's not gonna do a GME type move. Nonetheless, I just thought you'd like to see this. I started keeping track of the actual daily equity versus the SPY on February 9th. That's when I started to do that. And you can see here that SPY is in the orange, the fund is in the blue, and the fund as of right now is up 3.68%, 3.68% since February 9th compared to about 1% in SPY. You can see when SPY started taking a dip at the beginning of March, the fund also took a dip, but it was much smaller. And in reality, this was just simply because option prices inflated a bit. I do a lot of out of the money put selling in this thing, and all of these remained out of the money, but because of the option inflation, it kind of dips. Well, I also do some of these option sanity to help with the overall return, because if stocks are going up, then so are all of my, I think I'm in like 60 to 65 short option positions in this thing right now. And if stocks move up, these things are going to expire worthless, and so is the fund's going to move up. And so what this does is it brings in a little bit of extra premium. And if stocks absolutely skyrocket, it might take a small loss, but I've got a lot of other positions to make up. So it's kind of a synergistic type deal. So if you're interested in something like that, you can type something in the questions box, and I'll give you more information on that. Website's coming out pretty quick on that. All right, so let's move into a couple of trades that we took before we get to the Monday Wednesday combination here. This was the trade that we were talking about on Friday, and had gotten into this trade at a 5-cent credit. The market had moved down, and it looked like it was dead, and I was just going to take my $5 type deal. But then the market moved back up, and on Thursday, so this ended on Friday, but on Thursday, I had about $100 profit, open position profit on this thing. And we talked about the exit. And I'm not going to go back into that in any detail. If you want more information on the exit of this particular trade and why I chose to exit at $100 when, if the market would have moved up, I had much bigger profit potential, you can do that. Just go back and listen to that. But it ended up being the right decision from the standpoint of money, because the market was pretty stagnant on Friday, and as I said that they would do, they crushed the value of the Monday options. The volatility in the Monday options absolutely got hammered. However, it wasn't as bad as I thought it was going to be. Nonetheless, this ended up giving back quite a bit of the profit, not all of it, but quite a bit of it, and I ended up making $100 on that trade. Here's the trade that I was in for this week. And this is a crazy calendar type trade. And I mentioned that this week is ex-dividend. That means we have to be out on Thursday. Plus, they price the options differently than they do in normal weeks, because the market's going to adjust on Thursday after the close to account for the dividend payment. So they'll adjust the price down. The option prices are already taking that into account. And so that's why we got 10 cents on these calendars. And they're really going to be priced closer to a diagonal spread as opposed to a calendar spread. And so you have to be careful on that, because this profit bubble is not nearly what it said. Of course, what happened is I put this on when the market was trading around 383, 384, somewhere around there. And of course, the market skyrocketed. And it immediately moved up to 395, and that's where it's been trading last several days, hovering around the 395 area, 394 area. And I think that's where we're trading right now. Let me see here. We are at we're right under 395 right now. So this is where we're at. We're right at the profit peak. And I did have $171 loss on Thursday, as you'll recall, open position loss. And I said, there's nothing for me to do except hold this. And as of right now, it's $144 loss. And this profit peak is not going to be anywhere near the $250 if we're here by Thursday, because of the fact that they're going to drop the price of the out of the money calls or at the money calls in lieu of the ex-dividend pay, or the dividend payment that will be made. So we'll see where this is at on Thursday, And if the market keeps moving up, I'll end up taking a loss on this trade. If I can get out on Wednesday or Thursday near a break even, I'll absolutely do that. And if the market's trading at around 392, then I should have a pretty decent profit on the trade. It's not going to be huge, but it won't be a loss at that point. Okay, so we'll take a look at that again on Friday. And again, this is a trade that I warned everybody, don't take this trade, especially if you are a beginner because of the ex-dividend week. But I was going to do it anyway because the market, it was way out of the money, and it's a good thing to always watch these and learn from them anyway. Then I also took on Thursday, was it Thursday that I was filling this? I don't recall. Another trade, again, it was out of the money, and it was 319, 322. And again, because of ex-dividend, you got to be careful about this. But this was a risk-free calendar setup. And I started with the absolute minimum. Well, it was not the absolute minimum, but it's pretty close to the minimum core trade that you might want to consider. And this was a 398 short and a long 403. So a 5-strike difference, and I did 2 of them, and I did 2 of them at a credit of 97 cents each. That gave me a total credit of $193, $94, excuse me. And then after that was filled, I then put in an order to buy the 401, the 322 expiration 401 call. Hopefully you can see that. And that was not filled on Thursday. I said the probability of that being filled was extremely high. It was filled on Friday at 80. I only did 1. That means I still have a total credit on this thing at $114, right? So still have a significant credit on this thing. And this ends again this Thursday is when I will need to get out, and I will most likely be getting out at if they run the market up, I might get out at around 397, 398. We'll see where the market's trading and where the prices are. But you'll notice that I could get out of one of my core trades. I can almost not quite eliminate the risk, but I can lower the risk substantially by getting out of one of these 398 403 spreads at a small profit of $30. That will still give me a pretty decent credit of about $50 on the entire trade. I won't have near as much risk, and I've got this this extra long as well. Now, I do have an order in place to sell a 319 401 call for 80 cents. It's most likely not going to get filled the way that it's looking now. So whatever credit I have, I can probably, unless the market does shoot up, I can probably just count on that being the credit, and that's that. So, so in short, I've got a really decent trade as if the market stays the same or moves down, and if the market moves up, I've got a plan to sell more premium, and then possibly buy another 401 call, and then sell another 401 call, and then buy another 401 call. Time is running out though, and so I don't expect that to actually transpire. Nonetheless, that's the plan, and it's really simple. And I didn't get crazy or complex or anything with this particular trade. I just I kept it at 401. Now you can start and you can say, okay, sell. Well, actually, I can't do that because I bought and I have an extra long. I really need to stick with selling the 401 and being patient with that. Okay. If I had already sold the 401, I could actually start the whole process with a different strike if I wanted to, but that's not the case. All right, so let's move to the Monday, Wednesday combination. So I started looking at some Monday, Wednesday combinations at the request of one of you guys. I forget who it is that asked this. And so it's your fault that we kind of changed up the schedule a bit because I started going down a rabbit hole on Thursday. And so I looked at various things, and here is a type of a crazy calendar. Now, you can't put this order in the way it is because it actually has a 4 lot, and they're cracking down on orders with more than a 3 lot within the complexity of that order. And so you actually have to do a 1, 3, 3 or a 1, 2, 3, and then you can add a calendar spread after that if you want. But essentially what this is it's a short 396 and a long 400. That's a diagonal spread, and then it has 3 calendar spreads in it, and this of course is 322 is Monday for the shorts and Wednesday for the long. And on this particular one, you'll notice that there is a credit on this. It's at 27 cents. And this was on 311 right before the close. Okay, so this is out of the money. Again, we're trading at about 395 right now. Thursday, it was trading a little bit lower than that. So it was a little bit further out of the money. But this one doesn't expire this week, but next week. And of course, this particular trade expires today, right? Because it's Monday. And so that'd be a 315 and 317 would be this trade. And we're going to take a look at that here in a second. All right. So this is basically the same type of trade, crazy calendars that we've been doing on Monday, Wednesday, only they're not quite as far out of the money, and you are still able to create a small credit. It is only 3 calendars, not 4. However, the thing about the Wednesday option on Monday is that it's not going to tumble as much as a Monday option will tumble on Friday. And so you don't quite have the same type of risk of a volatility crush occurring on the trade. At the same time, there are still those similar elements, which we're going to talk about here in a second. But before I do that, here is a similar trade, only it's a 392, 396. Okay, so the first short is at 392, and then the 396s are the longs. And this one happens to expire today. And this was at a 5-cent credit. And right now, as it is trading at, I believe, like a $1.78 gain. And so there's still a little bit of time value left on the shorts, but we're going to take a look at that. I just wanted to show you the risk graph. So it's very similar to a crazy calendar trade, only slightly different in that we've got the diagonal spread and the calendars at the same strike on this particular one. Okay, so we're going to take a look at this one here in a second, and we're going to start comparing prices on this, and then we're going to take a look at the graph a little bit in a little bit more detail. Okay, so this is 322, 322, 324. That's next week. Here is this week's. And the same trade, 396 with the 400s. And you can see about an hour ago, it was trading at a $1.33. So if you were to get involved in this trade, right here, it's slightly out of the money, expires next Monday. So it's 1 week from today. And we get to next week. This is what it's looking like. $133, still out of the money. We're not even at the profit peak. That that really bodes well for what we're trying to do, because the more opportunities we have to exit a trade at a profit before it gets into the risk zone, the better off we're going to be. And this one, from my initial look at it, it looks like it's going to offer that possibility more so than the Friday, Monday. However, there's a caveat, okay? So here is the in the money again today for 315, 315, and 317. This was as of the close of Thursday. And this was in the money by about 4 points. The market was trading around 393, so the calendars were in the money, and it still showed a debit on this trade, which means that if the market goes 4 points past this profit peak, right? 4 points past the profit peak, so that would put this one at 400. This particular trade is still showing a debit. It's not showing a loss as of Thursday. Whoops. As of Thursday, right? So that's something to look at, because if the market is trading past the profit peak and it's still showing a debit, that would also be very, very favorable. Here is the 392, 396s as of 311, right before the close. And again, this is 315, 315, 317. So again, this expires today. This is in the money as far as the diagonal spread is concerned, 392, 396. We're trading at about 395. So we're almost being at the money. But on Thursday, when the market was trading around 393, this was actually at a debit of $1.92. So that's a $200 profit 2 days before, and it's slightly in the money. 2 days before, 2 trading days before expiration, it's slightly in the money. All very positive things. The only issue here is this. We still have to look at this. I warn everybody, multiple times, when you're in Friday, Monday trades, you really want to be aware of what's going on Monday. Is there something that will hold the value of the Monday option higher? If the answer is yes, you got to be clear. You got to be careful with option insanity trades, because option insanity trades were short Monday. If the answer is no, there's nothing going on to hold the value of the option higher other than just normal time and normal volatility, then you have to be careful with our normal trades, crazy calendars, the TPO, bearish, bullish, et cetera, et cetera. Well, you have to do the same thing on this. So here's what's going on this Wednesday. And do you see anything that might hold the value of the Wednesday option up today? Yeah. All 4 of these, all 4 of these are favorable for holding the value of the Wednesday option up. So if you can get into a trade, a crazy calendar trade that's out of the money at a credit, when the Wednesday option has a lot of stuff going on that give it a very high probability of maintaining its value at the close of Monday, then I would get all over those. However, you can't expect this week to be like next week. And the reason is because, I'll bring this down, there is some stuff going on. All right. So there is some stuff going on. Here's Wednesday. You have durable goods. You have core capital goods. You have market manufacturing, PMI. That's a pretty good one. Market services, PMI. So you've got these 4 things. You also have something on Tuesday with new home sales, and that might keep the value of those options up a little bit more as well, because we're going to be out by Monday, right? And so Monday we have existing home sales, and that'll be over at 10, and after that, Monday options will fall by the wayside, and it just depends on how much this information will hold up the value of Wednesday options. So you don't get a free pass on this thing just simply because it's not Monday. These things are very difficult to determine on how much value that they're going to hold up. However, having said that, I'm going to bring in the profit graph. Okay. And here is the 396, 322, 324, 396. You can get this thing at a 26-cent credit, or at least you could. You may not be able to now, but you could. And this is at a 26-cent credit. And you can see here it's a 396 with three diagonal spread. Sometimes my mouth doesn't keep up with my brain. And then sometimes it's the other way around. This is a diagonal spread of 396, 400, right? That's what we use to pay for the calendars, and then it's 3 calendar spreads at 400. Total credit of 26 cents. You notice nice profit peak here at the 400 level. It doesn't scream to the downside after the profit peak, and that should be pretty accurate right there. And you're not going to lose $200 until about 404. And again, this expires in a week. So if you get into this trade right now and the market screams up to 404 and kind of just stops there, then you might lose about $200 on this trade. But the probability is definitely not there, right? The probability is very much in favor of it passing through this profit zone slower than that and giving you an opportunity to get out of the trade. However, we do have Wednesday announcement from the Fed that could send the market screaming higher fairly quickly. It could send it screaming lower fairly quickly. It could bounce it around and then just settle about where it's at. We just don't know. All right. And so there is still obviously the risk of that happening, but look how far the market has to move for that to happen. And you've got this nice big wide profit zone. Plus you have a credit of 26 cents. So can you average $20 a week on this trade? I think you can. I think it's very, very possible without doing anything special. I think you can average more than that by just sticking with something like this. However, it requires more watching. Again, I have not been watching this particular combination. And so I have a really solid idea of how it's going to work out in the long run, but you still have to be diligent with how you approach valuing these long options. And so I'm going to go through a bit of a process here, and I think it's important. And in the new PDS Trader, which will be coming out, it's slated for about right now for April 30th to be released to a group of beta traders who want to beta test it. Hopefully we make it. It looks really good so far. We've got a different volatility calculation going on than just simply using our data providers. I've complained about our data providers calculation for years and years. I've said we need something different, especially for stock index markets. Well, we're going to have something different, and so it'll definitely be more accurate, but you still have the variables that a math calculation cannot take into account. There is no math calculation that can take into account the Fed announcement and what that Fed announcement is going to do to at-the-money options on Monday, on Tuesday, and Wednesday, or Wednesday expiration, I should say, options for the pricing on Monday, Tuesday, and Wednesday. So this is something where you want to go in here and you want to take a look at at the average Wednesday at the money option when the market is up on the close Friday. And you'll notice if you go back, and I did this to some degree, and it is significantly higher than the, for example, the Monday option on Friday. And there's a couple of reasons for that. The main one being that you have 2 full trading days left on the option versus on Monday options, you only have 1 full trading day at the close on Friday, right? So you've got that going for it. And then the second thing is that there tends to be more announcements on Wednesdays. And so that helps keep those values up. So I want to take a look at this. I'm going to tell you what the last Monday's option at the money call was on Wednesday. Wednesday's at the money call was on Monday's close. And that's what we're looking for. All right, so here is the projection. And hopefully everybody can see that. My long is leg 2. And it's a 400, and I've got it set right over the 400 level. Okay. So what is leg 2 projecting? And that's a profit. That's not a price. That's a profit. So leg 1 is if the market trades at 400, leg 1 is projected to lose $215 because it's in the money by 4 points, and I sold it for 185. Right. So that's a no-brainer. Leg 2, however, expires on Wednesday. And so there's still going to be some time value in that one. And on this particular one, it says $349 profit. That is net. That's not per. I'm long 4, so I actually need to divide my 349 by the number of longs I'm in. And that says that I'm going to make 87 cents per long if the market is trading at around 400 on Monday. Okay, this coming Monday. And meanwhile, obviously, the 400 shorts will expire worthless. They actually won't expire worthless. You'll have to exit them, but they'll probably exit for 5 or 6 cents with a few minutes to go. And at that point, you've got 3 calendars that are going to be worth about $180 based on this projection. So that's $180 a piece, and that comes to $540, and then you subtract the loss that would occur on the diagonal spread, and you come out to about $335 profit potential. That's actually pretty accurate from what I can tell, or it should be pretty accurate from what I can tell. So last week, the Wednesday expiration option on Monday closed at 232, not 180, 232. That's a 50 cent per option difference. So on 3 calendars, that's $150 of extra profit potential. Plus your loss on the diagonal spread would be $50 less. So you're talking about a $400 swing. That's $400 above what this profit projection graph is showing. I think the range is probably going to be between, right now with where we're at, it's going to be between 160 and 200, or $1.60 and $2, depending on what announcements are going on, volatility in the market, et cetera, et cetera. Obviously, if the market moves up, we still have the same principle that is working, and that principle is that as the market moves up, volatility drops out of the calls. That is still working, and so you have to factor that in. And so I think this is probably really accurate for next week. If the market is trading up at 400, I think there might be, there might be some room for this to drop down, maybe to $1.60-ish a piece at 400. But still, at $1.60 a piece, you're still talking about the calendars being worth, all three calendars being worth almost $500 at that point. And so you should have still a pretty decent profit. More importantly, the question is going to be whether what we see, and I'm just giving you my analysis based on the current this week and what I'm expecting for next week and what we have to look at and what we have to look for. This is, if I ever look at a new spread or a new combination, this is the process that I go through in analyzing it and trying to determine the validity of what we're expecting on this thing. And so the first thing that, oops, I want to move this out. The first thing that we are expecting or hoping to expect at this point is the value of this trade increasing before the trade ends. The value of this trade increasing before the trade ends. So this particular one was 2 days away. This was right before the close on Thursday, and this is 392, 396, 396, right? So that's $1.92. Obviously, at a credit of 5 cents, that's a huge increase. This is probably not realistic. I think we see the effect of the Fed Reserve announcement on Wednesday, kind of bumping up these prices a bit on the Wednesday option that are not going to bump up the Monday option because Monday will be expired before Wednesday, right? So why would Monday be affected by something that's going to happen on Wednesday? So I think you have a bit of a skew here that it's not going to be quite what you can expect moving forward next week or the week after, et cetera, et cetera. So that's the first thing. And then the second thing, obviously, is where's this thing going to end as of next Monday? What are the values of the Wednesday options going to be if you hold on until expiration? Because on the Friday, Mondays, we often don't hold on until expiration. You might actually be able to hold on to this one until expiration and not have to worry, or at least until the last day and not have to worry about quite the same crash and volatility late in the day that you absolutely have to worry about on a Friday, Monday option. All right, so let's take a look at these trades and start doing some comparing. Okay, now I do have some good news, and why do I do this? Jeez, I started, so I might as well. So let me apologize in advance for I can't help myself. Sometimes I get excited about some changes that we're doing on Trade Partner, and then they don't happen quite as fast as I want, and everybody's looking for them. And I probably should have just kept my mouth shut. So I actually have a new way. I've been trying to work on this for some time, but I have a new way of viewing the spread patterns in Trade Partner to where you can view a bunch of patterns, different expiration dates, all in one grid. It's a spread matrix, if you will. And so you can quickly and easily compare the prices between this week's and next week's and the following weeks and the following weeks, all on one in one matrix, if you will. And it's really cool because it's so much faster. That's obviously not what we're doing here. This is we're going to go through the normal process. This is 315, 315, 317. And this is the 392, 396, 396. So this is the one that was trading at $1.92 on Thursday. We're trading a little bit higher, and so it's actually trading at $1.76. But we're just going to look at all of them because this trade ends today, right? So we're going to look at all of them and just kind of gauge where we're at with this stuff. So here's in the money by a couple of points, and it's at a small credit. And so the one that we're looking at for next week credit of about 25 cents. So keep that in mind as a barrier, and that's a 396 400s. That would be the context, if you will. So we'll compare all of these compared to that one. So if that one goes in the money by a couple of points, we should still be making money according to the current trade that is similar, only that expires now instead of next week. All right, because these are 392s and we're trading at about 395, and it's trading at a 7-cent credit. If we get in at a 25-cent credit and it's trading at a 7-cent credit, then that means that we still make about 18 bucks on the trade. Okay. Again, I think this is different because of the Fed announcement on Wednesday. I think it's keeping these options up a little bit more. So this is probably not going to be accurate. And we're going to take a look at this on again on Monday and see where the 322s and 324s were. Nonetheless, you come in here to 389, 393s. This is closer to it at the money. It is still slightly in the money, but it's still in the profit zone. A debit of 84 cents. It's a $110 profit if you got in at 26-cent credit. Okay. The 390, 394s. This is slightly in the money, $1.65. Here's 391, 395s. This is at the money, $2. So that's pretty good. The 395s, 317, 395s. That's actually this was out of the money a little bit. Notice that that's a $1.56 versus 24, so there's still some room on that one. Then 396s, $1.74. 397s, $1.36. And you can see here the 397 shorts, basically worthless because they expire today. 394, 398s. This is out of the money, $1.16. Go another point out of the money, $1.04, 80, 51, 35, and 24. And this is 43, 403. So that's way out of the money by about 8 points. And it's still showing a debit of 24 cents. I don't know whether an 80 point out of the money one will still show it a debit of 24 cents in the future. We'll see. But obviously, if you get in at 26-cent credit, even if the market goes down, you still may be able to pull out $50 on the trade type of deal. So we'll see. All right. So that's the ones that expire today. Let's compare that with next week's. Same exact pattern. 388, 392, 392. So this is past the profit peak. We're trading at 395, and it's trading at a $1.83 credit right now. And the max risk on this trade, by the way, if you take a look at the diagonal spread, which is where the risk is, plus your calendars, right? But the diagonal spread is where is the strike difference. That's 4 points. That's what you subtract the credit from. So if you get this for $1.83 credit and you only have a 4-point strike difference in the diagonal spread, you're talking about a maximum risk on this trade of $217. Worst case scenario if the market continues skyrocketing. Okay, if it moves down to 392, you're going to be looking at a hefty profit. We'll see how far they'll go in the money next week and still be profitable. Again, I think it'll be different than this week, but that remains to be seen. Okay. All right, so let's take a look. 390, 394. So these are calendars that are slightly in the money, still a $1.34 credit. A lot of time value on this one. The same one right now, 390, 394s that expires today are at a $1.65 debit, not a $1.64 credit. That's almost a $400 difference right now. Okay. 391, 395s. So this is at the money. And we already know that that's going to be worth quite a bit of money next week. That's a $1.08 credit, so a lot of time value on that one. Let's just keep going out of the money. 83 cents. The 96 is slightly out of the money. 94, 98. So now we've gotten to where the diagonal spread is almost out of the money. And it's trading at a 44-cent credit. And we know that that's going to be trading at a significant profit. Next week, if the market goes nowhere, the current 394 398s are trading at a $1.16 debit. Okay, that's the one that expires today. And this is the one that expires next week. Same trade, 44-cent credit. Okay, so that's about $150 swap there. And the profit peak is still higher than where we're trading at. 395, 399s, 27-cent credit, and the 396s, the 400s, which is the one we were looking at, trading at a 16-cent credit. This whole thing is out of the money. And you could actually get this for 26-cent credit earlier, but 16-cent credit here. And if the market moves up, 26-cent credit will probably be available again. But this one expires in a week, and the market has to go up, and it has to go up significantly before you start losing money on this trade, provided that you don't have a significant drop off in the value of the Wednesday option on Monday. You're probably looking at a break even around 403 on this one. So high probability, 1 week, may have multiple chances to get out of this trade early. I would not suggest taking this yet. I'm going to take it. In fact, I already did take it, but I'll take it again. And we'll watch it, and we'll see what happens if the market moves up. That's really what I want to see, is what happens to those Wednesday options if the market moves up with the limited number of announcements that are coming out. But we'll keep an eye on the market calendar or the economic calendar. And anytime we see significant stuff coming out on Wednesday, this is definitely one you want to take a look at. And maybe one that you want to trade anyway. It just remains to be seen whether everything holds up the way it looks like it's going to hold up a little bit better than on Monday. All right, so let's go one more week out just so that you can see. This was 329, 331. And so we'll go same one in the money. 388, 392, so $1.22 credit. So this is where the calendars are actually in the money by about 3 points. $1.22 credit. 393 calendars, $1.08 credit. 394 calendars, 88-cent credit. 391, 395, 69-cent credit. Let's go up to 396s. And look at that. We have actually a smaller credit. So there actually might be something going on that following Wednesday that is propping that option up a little bit, because we can actually get a better credit on 322, 324 option, right? If you the 322, 324 is trading at a 16-cent credit. So it's clear no-brainer that you don't want to do this one. You don't want to do the 329, 329 right now. You're better off doing the 322. Again, I'm just going through the process, the analytical process. Okay, and from that point on, you have debits, which you don't want to put these on at a debit for obvious reasons. Okay. All right. So how would I put this on? You have to a couple of different ways of doing it. Let's do this. I'm going to do something just slightly different. And actually, I can't do something slightly different. I have to do it up here. And so I'm going to reset the spreads. Nope. Go to this one. All right. So here's what I'm going to do. 396 400s. I have to plop this down by 1. I have to do a 1, 2, 3. So this is basically a diagonal with two calendars, a diagonal with two calendars instead of three calendars, because they won't let me put the 4 lot in there. So I can do a diagonal with two calendars, 42-cent credit is what it looks like it's trading at, and then I can turn around and put in another order for an additional calendar for maybe 25 cents ish, and that's about what it looks like it's trading at right now. So that's how we would do this particular trade. All right, so I'll go, and I would do this in a smart order, right? But I'm going to put this on anyway. Okay. All right. Now, let's take questions. All right, looks like there are several. Yep, I didn't get to the profit stacking, and it's because I wanted to go through the Wednesday or the Monday, Wednesday. Yes, I will do a Wednesday, Friday analysis as well. Just not yet. Let's knock this one out first and get a good feel for it. Is there some place we can look up and find the current volatility on a particular option? Lawrence, that's a great question. The problem is that the current volatility does not equal what it's going to be when it's time for you to exit the trade. And that's where this whole thing just goes awry with regard to SPY options or stock index options, because we know the volatility is going to decrease. So you have to look at the prices. That is the important thing, is to look at the prices and compare the price projections with previous prices. And that's really where you're going to get, it's kind of a reverse what's the word I'm looking for? Reverse engineering of the volatility level to determine what the actual expectation is. All right, Michael, I will get you more information on the fund. I'm a new member and I put on a 1-lot trade to have something to work with. Would you please discuss how you price and put in your closing order for a simple bearish one and bullish strategy? I would need more. Kay, if you will type in the trade that you're in, I will be more than happy to cover that in Thursday, since we will be discussing a little bit about exits on Thursday. You are welcome, KS. So excited for the Matrix. It'll be perfect when we get it. Yep, it's pretty cool. On the Monday Wednesday expiration, would you still need the short option to be out of the money on 319 because of ex-dividend? Yeah, that is a great question, Harry. So the Monday option, if it's at the money, if it's slightly in the money, is probably going to have more extrinsic value on Thursday than the dividend payment would be. And that's kind of where they flip the switch. So if you have less extrinsic value than the dividend than what the dividend payment is going to be, that's where you have to take a look at your short Monday options. Wednesday, the following Friday, all probably fine unless they're deep in the money. So the key is to look at the value of the extrinsic value, and if that extrinsic value equals more than the dividend payment, then there's no reason why somebody's going to exercise and assign that option, right? So you're not going to be assigned. And if you are, guess what you'll be able to do? You'll be able to exit your assignment and then resell that option for a lot of extra time premium. Because if they assign you, you immediately collect the remaining time value of that option. So it's not a bad thing. But yeah, that's what you want to look for. How much margin on these trades? So these, this particular trade, the crazy calendar here, is going to take about $400 in margin. So it's not a whole lot. Do I have any news on Performance One? Yes, we've uncovered all sorts of bugs and the programmers are fixing them as we speak. And that's about all I've got for you on that right now. Terry, I will get you information on the fund as well. Maybe best to wait until after ex-dividend. Yeah, so on the wins, so first of all, you might want to tap the brakes just a little bit because, as I've said, I haven't watched this particular combination on any kind of consistent basis. And so, let me do. I've been doing this enough. I know where the risks are. I know what all the variables are, like the back of my hand. So nothing is going to take me by surprise. But having said that, I think you should probably just hold off before you start doing Monday, Wednesday trades just yet. I would strongly suggest that we get a couple of weeks of watching these, and then I'll be much more forceful on what you should expect. All right, Jerry, I will do that. What's the worst crazy calendar loss in dollars you have ever had to take? I've never taken the max loss, I can tell you that. I want to say it's around $200, but don't quote me on that. Yeah, I don't take big losses in that, hardly ever at all, simply because I'm going out of the money with most of them. This week was one of the situations where I went out of the money after the market had moved down, which always you should be cautious about. And I did it on an ex-dividend week. So this one, the one that I'm in right now, is probably about the worst one that I've been in from the standpoint of outlook. Let's see. I've been able to pull up opportunities with 2 strategies. Michelle, we are working on that, and that should be. And they I can only tell you what they tell me, and then when what they tell me is not accurate, it makes me look. So they're working on it, and I'm pushing them very, very hard to get that data issue pushed. Let's see here. Looks like I got all of the questions. And so we will go ahead then and end this call. And let me tell you whether I was filled on that trade or not. Looks like I may have been. And yes, I was. I was filled at a 42-cent credit. So I will add another calendar in there, and we'll see what happens with this trade. All right, everyone. Have a wonderful day. I will see you on Thursday.